All right, welcome everyone to the latest in Beacon's webinar series. My name is Mark Higgins, and I'm Beacon's Chief Analytics Officer and co-founder. Thanks for joining. All right, so today we're going to look at using Beacon for a typical quantitative risk application that, for example, a quant might implement on a natural gas trading desk. We're going to look at ways to efficiently hedge a portfolio of natural gas options in linear positions using something called a factor model to reduce the number of risk dimensions that a trader needs to keep track of. Then we'll turn that analysis into a risk report in the production trading system that shows delta and vega risk to those smaller number of factors. And one of the things we want to get across is that's one of the unique things about Beacon is this combination of a quant technology platform and a trading and risk management system. So quants aren't doing R&D in a separate standalone environment. They're doing it in the same trading system platform that has all the real production data already integrated, market data, reference data, all historical data, trade data, positions, and all that kind of stuff. And it doesn't stop at being a great R&D environment. It lets you take those ideas that you've tested in the quant environment and quickly roll those out to the production trading system. We're going to look at how this hedging approach performed in kind of normal markets by backtesting it and benchmarking its hedging performance against other standard metrics. And then we're going to look at how that model performed through some of the big moves in natural gas prices that happened in the lead up to Russia's invasion of the Ukraine, and see how well this kind of hedging approach would have worked in stressed markets. So to give a bit of context, here's a chart of NYMEX nat gas futures prices since the start of 2019. So beginning of 2019 out to last week. This shows 3 time series corresponding to 3 different points on the natural gas forward curve, right? So the forward curve means, a forward price means the price for buying or selling natural gas on some future date. The forward curve is the set of all those prices for a bunch of different dates. So the blue line here shows the price of the prompt futures contract. That is the futures contracts that's closest to settlement. So for NYMEX natural gas, there's futures contracts that settle once a month. And so this is the contract that's sort of closest to settlement, the prompt contract. The red line here shows the price of the third nearby. That's the contract third closest to settlement, so about 3 months in the future. And the green line shows the 12th nearby price, so about a year to settlement. And you can see the prices ramp up at the end of 2021 and into 2022 as the market got worried about Russia invading Ukraine. Now, for risk management purposes, the most important thing to remember about natural gas as an asset class is that forward prices for different settlement dates can move by different amounts. Some days maybe the front of the curve goes up and the back doesn't move much. Other days maybe the front doesn't move, but the back of the curve goes down. This is an important difference when you compare it to more traditional financial markets like foreign exchange and equities. For those, forward prices for different future settlement dates move with almost 100% correlation. So if the front of the curve goes up by 1%, the whole rest of the curve goes up by 1%. Because of that really high correlation, for modeling purposes and risk purposes, you can replace the whole forward curve with just 1 point on the forward curve, just typically the spot price, which is the very front of the forward curve. So you can model how the spot price moves around, you can calculate your risk to the spot price moves, and assume that the rest of the curve moves in sync with spot. But that's not the case for natural gas. Each forward price is kind of like a separate asset that you have risk to. So for example, if you've got a natural gas futures market with monthly contracts trading out to 2-year settlement, that's 24 different futures prices. So 24 different assets you've got risk to. And that's a lot of numbers to keep track of when you're hedging. And in practice, traders want some way of reducing that big list of risks down to something more manageable. There's a bunch of different techniques for reducing the number of risk dimensions. A simple one is approximating forward curve moves as parallel. So assuming that all future prices go up and down by the same amount when they move. We know that that isn't true, but futures prices aren't entirely uncorrelated. Like if I'm long the future for June 2023 and short the July 2023 future, that's going to be a pretty good hedge because those 2 contracts are going to be pretty well correlated. But they're not perfectly correlated, but they're pretty well correlated. So if you imagine you've got a delta report and it shows you delta to each individual futures contract, there's 24 different numbers in your report. There might be another number, which is it's the sum of all those deltas. and that number shows you your risk to parallel curve shifts. And so if, as a trader, all you do is hedge that total delta, the sum of all the individual deltas, then you're hedging parallel curve moves. And so you've reduced your sources of risk from 24 different risks down to just one. So you've done a lot of risk reduction, but in practice, because like we said, different futures prices move by different amounts, it doesn't work that well. For example, if you look at the move in the curve kind of at the end here in April 2022, let's say you were short the prompt future, the blue line here, and you're long the 12th nearby as a hedge, expecting that curve moves were in parallel. Well, the front of the curve moved up by kind of $4, and the back of the curve didn't really move very much at all. So you would have lost a whole bunch of money when you thought you were hedged. So it doesn't work that well. So let's talk about something that hopefully works a little bit better. This is factor model analysis. So factor models are a way of reducing risk dimensionality in a bit more of a quantitative way. So with a factor model, what we assume is that when the forward curve moves, all the different forward price moves are driven by just a small number of shaped shocks. That means on any given day when the forward curve moves, we model that move as some linear combination of a small number of shaped shocks, for example, just 2 or 3. A really kind of trivial example of this would be like a parallel shift and a tilt move are the two factors that move your curve. So parallel shift, everything moves up and down by the same amount. A tilt move, the front moves up and the back moves down, or the front moves down and the back moves up. And on any given day, there's going to be some random parallel shift shock up and down and some random tilt shock applied on top of it. And you can imagine that gives you modestly complex moves in the forward curve, but they're still driven by just 2 sources of risk. So you've reduced the number of risk factors from like 24 different individual futures prices down to just 2. So that's the idea with this kind of factor model thing. Here's like a little formula that shows kind of formally, mathematically, what we're assuming here. So F here is the forward price for some settlement date big T, as seen at some current time little t. So dF over F is kind of like the return in the forward price. You can see here it's the sum of n different shocks. The DZ 1, 2, 3, all the way to n are n different random shocks, and each shock has some scale, which is defined by this parameter sigma, and it has a shape, which is this exponentially decaying shape. And how quickly it decays is determined by this parameter beta. Beta is often called the mean reversion. So if n here is like 2 or 3, there might be 2 or 3 different exponentially shaped shocks that get applied to the curve with different exponential decay speeds, so different kind of shapes that you get from the different exponentials. And there might be some correlation between these different shocks as well. So there's a bunch of parameters to this thing. There's the sigma parameters. If there's n factors, there's n sigma parameters. There's n mean reversion strengths, these betas, and there's n times n minus 1 over 2 correlations between those. So that's sort of the kind of formalism behind this, saying in a factor model, we're assuming that there is n shocks that are these sort of exponentially decaying shocks. And we're assuming that when the curve moves, it's some linear combination of those. So let's go and jump into Beacon and see how this actually works. So here I've got a Jupyter notebook. So Jupyter notebooks are pretty standard tools for quants. The programming language it uses is Python. Again, a really common language for quant and data science work, and one of the most kind of the central programming language inside of Beacon overall. There's lots of different ways people run Jupyter notebooks. This one has the advantage of running inside the Beacon platform. So it's connected to its data environment. So it's easy to get all the data that you need to run analytics. It's connected to like the parallel compute engine, which we'll look at in a little bit, which lets you do a lot of computationally complex calculations quickly. So let's look at this model. So we're going to try and figure out what the parameters are of that forward curve model that best matches the way that the market actually moves. So I'm going to have 3 factors in this model. Then what I'm going to do is define a historical range, a historical window that we'll use to calibrate the parameters of this model in. We're going to use one that runs from the start of 2020 to the middle of 2021 before all the Russia stuff picked up. So the idea is we can, for every date in that historical window, we can look at how forward prices move day to day. So we'll look at forward prices with some constant tenor forwards, so 1 month, 2 month, 3 month, all the way up to 3 years. So there's like 13 different tenors that we're looking at here. So in any given historical date, I can say how much from that date just to the next date for 1 day change did all the forwards of those different tenors move. So 13 different returns for a given date. And then I can look at the volatilities of those returns and the correlations between the returns across the different forward tenors for that whole historical range. So if I've got 400 dates in my historical window, then I have 399 returns that I can use to calculate volatilities and correlations. Then the idea is in that forward curve model, I've got 3 sigma parameters, 3 beta parameters, and 3 correlation parameters. So I've got 9 parameters. I want to say, if I choose some particular set of those parameters in the model will tell me what all the volatilities and correlations are between moves and forward prices. So I want to say, what are the parameters that I should choose that makes the model estimation of volatilities and correlations tie out as closely as possible as to what I see from history. So that's what this Jupyter notebook does. Here, for example, it grabs a handle to a time series that has all the natural gas futures prices in it. In Beacon, a lot of our data is stored in time series. This gives you an interface, and then you can ask that interface, give me all the time series values from the start of my historical window to the end. The value of the time series for any particular date is the settlement price of all the different futures. So for a given date, it's got the whole future settlement curve for that date. And then it goes and interpolates these constant tenor futures prices. And then it does some root finding. So it says, let me go and numerically solve for the parameters of my factor model so that the factor estimates of volatilities and correlations are as close as possible, a best fit to what I see historically. And so for this, it's using standard Python libraries like SciPy, which have all this kind of built-in optimization built in. And so here I can go and see, for example, when it does this fit, it shows me the mean reversion strengths of these 3 different factors. So one of them is a fast factor with a mean reversion strength of 3.5 per year. That means a half-life of sort of, log 2 over 3.5 years. Another factor with a half-life of, or a mean reversion strength of about 1.4. Another one with something around 0. So that kind of defines my shocks, and then I can go and plot out, what those shocks look like. Here's, 2 of the 3 shocks. I've left out the one with mean reversion strength of minus 0.14. That looks pretty much like a parallel shock. Here's the shocks for the other 2. Right. Okay. So now, for example, we've imagine we've done this kind of analysis a whole bunch. We've done a whole bunch more testing of the factor model. We've tried out different numbers of factors and different shapes and looked in practice at how well the model predicts daily moves across the curve and all that kind of stuff. And now we end up in a position where we're reasonably happy with this kind of factor model. But this is all kind of theoretical. We're just talking, doing sort of time series analysis in Jupyter notebooks. No one on the trading desk can use that particularly easily. So now what we're going to do is take advantage of the fact that Beacon isn't just an R&D environment. It's also the production, trading, and risk management system. So what we want to do is turn this kind of theoretical factor model stuff into something that traders can actually use on the desk to manage their portfolio risk. And the way we're going to do that is with a risk report. We're going to build a new risk report that wraps up risk to these different factors. So the risk report is going to do things like calculate risk to the factor shocks. That's like factor deltas. So it'll basically say, take the current futures curve, forward curve, apply a small shock from the first factor, and see how much I make or lose, see what my profit or loss is from that. That's my delta to the first factor. And then I can do that for each of the other 2 factors. So in a 3-factor model, I end up with 3-factor deltas. But if I've got options in the portfolio, delta isn't the only thing I care about. I also care about my gammas. So there's also gamma risk here, which is a little bit complicated. It's like factor gammas. So the gamma to the first factor would quantify how much the delta to the first factor changes as this curve is shocked up by the first factor. But there's also cross gammas involved, right? So this means how much does your delta to the first factor change if the curve is shocked by the second factor? That's the cross gamma between the first and second factor. So with 3 factors, there's 3 cross gammas as well. So we need to measure that. So we need to have a risk report that shows us risk to for a 3-factor model, 3 factor deltas, and then 6 factor gammas and cross gammas, right? 3 factor gammas, 3 factor cross gammas. So we could build that risk report and this show, delta to factors, but no trader is going to have any idea what that means, right? No one knows what a risk to a factor is. It's too abstract a thing. So it's much better to express that risk in terms of actual hedge instruments. So our report's also going to figure out the quantities of 3 reference futures contracts that give the same factor delta risk as the portfolio. So then I can I can sort of translate or rotate my risk to the factors into risk to 3 futures contracts. Now I've done what I originally set out to do, which was reduce my, risk to 24 different futures contracts down to just 3 in my 3-factor model. So I've reduced my risk dimensionality that way. But there's also gammas, and so what I'm going to do is, instead of showing factor gammas, which again are hard to understand, the report will figure out the notional of 6 different options, because there's 3 gammas and 3 cross gammas, so 6 total gammas that I need to hedge. So I'll have 6 different options with 6 different expiration dates. I'm going to figure out the notional of those 6 options that have the same gamma and cross gamma exposure as the portfolio. And then I can show in my risk report those option risks in terms of vegas of the options. Typically, that's the unit that traders normally think about option risk as. So I'm going to translate my 3-factor deltas into 3 futures deltas and my 6-factor gammas into 6 option vegas. And then I'll have a risk report that traders can actually use to go and hedge the risk of their portfolio. So let's jump into Beacon's IDE and see how this is actually done. So what I'm looking at here is the IDE. So this is where developers go, check out code, go and make a whole bunch of changes, do their testing and all that kind of stuff. It also has workflow tools for then deploying those changes into the production environment when you're happy with it. Beacon includes a risk reporting framework. It lets you define basically a tree of different market scenarios and then values to calculate in those scenarios. In this case, the values to calculate will be those factor deltas and gammas. So let's see how that works a little bit. So I've got this new class that corresponds to my risk report, the commodity factor risk report, inherits from this base risk report class that kind of defines the framework. And there's a bunch of things I need to define, like the name of the reports, parameters. It'll go and figure out which markets I've got risk to, so it knows which markets to calculate risk against. And then the main method here in the report is this tree method, which defines the tree of scenarios and values to calculate. So it basically says for each market, I'm going to make a factor risk value. The factor risk value then is something that has its own little tree of values, where I'm going to say I'm going to for each of my factors, I'm going to shock the forward curve up and down by the factor, so I can calculate delta and gamma to the factor. And then it'll have a scenario where I shock 2 factors at the same time, so I can calculate my cross gammas. And then the rest of the report, so if you go to the end here, it's 550 lines of code or so. So not that much code to define this brand new kind of risk report and all the logic that goes and translates my factor deltas and gammas into risk to 3 futures contracts, so 3 deltas, and then 6 option contracts, option vegas. So I can hop over here to a little test script and see how this actually works here. I'm going to switch to the close on some specific historical date for me to just test it out. Then I'm going to build a little portfolio here that's got at the money options for a bunch of different tenors and stick them into the portfolio. Beacon lets you kind of on the fly have access to this really high level financial object framework that lets you build portfolios of things really easily. Here I stick it into a portfolio, and then I can run my risk report on it. So if I run this guy here, then the first risk report shows me my 3 deltas, and then it shows me the sum of those deltas, right? So it's reduced my risk from 24 different deltas down to 3, and then it shows me my gamma risk in terms of 6 different options. The rest of the script goes and does something interesting, like say, let me go and take the equivalent option risks that the report calculated and stick those as hedges into the portfolio. And so if I do that, I should zero out my option risks. And so you can hear when I run the report a second time, here's the code that runs the report a second time, I can go and see that the Vega risks are all zero. It's a purely linear portfolio from the perspective of factor risk. By the way, this is all printing out in kind of like a really simple text format. That's just a convenient output for doing analysis inside the IDE. In general, all these risk reports support a nice app-based user interface, a pivot table report. So when traders run these from, Beacon's quote tool or from the trade blotter or in our real-time risk framework, there's kind of pivotable tables of risk where you can drill into the positions and things like that. So you get all that for free when you use Beacon's risk reporting framework. The other thing that's interesting about Beacon's development environment is not just a development environment, right? So I've checked this out and I've made all these changes. I've done whatever testing I want to do. Now maybe I'm satisfied with my changes. I can now go and follow workflow tools inside of Beacon to wrap up all these changes into what we call a feature branch, which is just like a little bit of a kind of segregated bit of changes that corresponds to just the changes you're making for this thing. Then your peers, the developers' peers, can go and review those changes, sign off on them. You can have people on the desk sign off. You can run through standardized testing frameworks, all that kind of stuff. And then once you've satisfied whatever those controls on code release are that your institution wants to implement, and Beacon has a control framework that lets you set those up. Once all those controls are satisfied, you can then go and immediately release this change out into the production system. So you don't have to wait for like a bi-weekly release date when your change goes out with a whole pile of other unrelated changes. You can make little atomic changes like this and get them out to the desk right away while still satisfying modern control requirements. All right, now before we roll this out to the desk though, we want to test it a bit more thoroughly. That is, we want to see if it's an effective way to manage risk for a realistic portfolio. So the way we're going to test this is with a hedging backtest. So for a given historical date, we'll put on some reference portfolio, maybe like long options across the curve out to 1 year, run the report, it'll tell us what hedges to do, add those hedges into the portfolio, all at closing mid-market prices, just like we did in that little test script there. It's easy to do this in Beacon. Again, it's not just an environment where you can play with time series data like in that Jupyter notebook. You can also construct these synthetic portfolios, the different derivatives, price them, run risk reports on them, and stuff like that. So we can write a script that does exactly that and calculates the profit or loss, the P&L, that portfolio, portfolio of long options hedged using the factor model hedges, experiences over 1 business day. So for 1 historical date, we can calculate a 1-day P&L. We end up with 1 P&L, 1 profit or loss number. And then we can do that for all the historical days in whatever window we want to backtest over. And that gives us a whole pile of daily P&L numbers. And from that, we can get a profit and loss distribution, a distribution of daily P&L. Now, obviously, the smaller the standard deviation of that P&L distribution is, the better the hedging is. So Beacon's quant platform also includes a grid compute framework called WMP. This lets you run all those daily P&L calculations in parallel. So you can run the P&L calculations for all the different historical dates all in parallel on a pool of cloud compute that scales up when you start the calculation, shuts down automatically when no one's using that computer anymore. So it automatically elastically scales up your compute when you need it and shuts it down when you're done to minimize your cloud compute costs. So if there's 400 dates in your historical window, you'd spawn 400 separate parallel calculations, 1 for each historical date, and then they can all run in parallel on however much parallel compute your pool is configured to use. So being able to run this kind of computationally expensive calculation easily is an example of this powerful enterprise technology functionality Beacon gives developers. So So now we can do this for our factor model hedges, and we come up with a distribution of daily P&L, but we need something to compare that against. So we'll compare it against two other hedging strategies. So one where we'll calculate that same daily P&L standard deviation, assuming that I'm hedging just with a parallel delta hedge. So hedging the whole risk of the curve with just one future, assuming all futures price move by the same amount together. And the second one we're going to compare against is a factor model where we just hedge the deltas, and our benchmark case is one where we also add in those option hedges to hedge both the factor deltas but also the gammas. So here is the result of that back test represented as P&L histograms. So the blue bars there are for the parallel delta hedge. The green is for hedging just the factor model deltas, and the red is hedging factor model deltas and gammas. So unfortunately, these aren't particularly compelling at all. It kind of looks about the same. The factor model doesn't do a whole lot better than parallel delta hedging does in normal markets. That's because I've swept under the carpet a lot of the other complexity in natural gas markets. That means a simple factor model like this one doesn't work terribly well. And the biggest market dynamic that we've left out is called seasonality. That natural gas volatilities and correlations can vary with season of the year, like spring or summer or winter or fall or whatever, and not just with the sort of tenor of the forward contract, the time to settlement from now to the forward contract. But it is okay, and it gives us a way of reducing risk dimensionality that has some quantitative justification and gives us a path to more sophisticated models that perform better. And generally, that's how this kind of quant research works. You come up with an idea, you run it through stuff like this, and then you go and figure out where that works and where it doesn't work, and you can see how to make it better. Okay, so let's move from sort of behavior in normal markets to behavior in stressed markets. So I'm going to go back to another Jupyter notebook that lets us look at that. So here I've got a Jupyter notebook. It defines 2 dates. So let's look at the market move from February 15th to February 16th, 2022. So before Russia invaded Ukraine, when everyone sort of expected they were going to. I've got my 3-factor model defined by the 3 different mean reversion strengths for the different factors. Now what I'm going to do is say, let me look at how much the curve actually moved from the 15th to the 16th of February, and then what the factor model would have predicted that it moved. If I sort of best fit the weights for those 3 factors to match what actually happened in the market, how good a fit is that? So here I'm going and doing things like saying, you know, let me pull in the forward curves on these 2 different dates. Here, instead of going to the time series directly, I'm using a higher level financial object interface that lets me say, you know, switch my entire market environment so that it looks like, you know, the close on date 1, then ask this object, this well-defined object here that represents market data for NYMEX nat gas, ask it for its forward curve, and do that for the second, and then calculate the returns. And then I can go and, you know, easily solve a little linear system to solve for the size of the shocks for each of my 3 factors that best fit the move that actually happened. And then I can go and plot it out. So, you know, it's a pretty big move, right? The front of the curve moved up about 10% in the front, back only moved about 2%. So the blue line shows the actual market move, kind of wobbly, and the orange line shows the best fit of our 3-factor model to that. So a couple things to note here. First of all, it does okay. It, you know, gets broadly kind of the overall shape of the daily move in the forward curve, but it's missing some interesting stuff around these kind of wobbles here, which have to do with seasonality. So again, the fact that we haven't incorporated seasonality of nat gas prices in our model means that we're missing something important, and kind of to make this kind of thing work well for natural gas, it's important to include seasonality. So let's finish off. You know, the goal of this was to demonstrate how you'd research a new hedging approach, kind of at the quant R&D level, and then turn that into a real risk report that traders can use on the desk, test it at scale, doing things like hedge backtesting using parallel compute, and deploy it to production so the business can actually start using it. And that's what Beacon's really great at, not just being a great quant platform or a great risk system, but turning those insights into production functionality quickly and under control. Some pieces we saw the quant platform where you can run notebooks that are integrated with the production data and compute environment, the IDE where you can build, test, and deploy production code. We saw Beacon's risk reporting framework that makes it easy for developers to build new reports and roll them out. And remember, it's not just Beacon's own developers doing this. This is something that quants at a Beacon client can do themselves without any engagement required from us. We also saw Beacon's WIMP parallel compute machinery that lets you run parallel calculations on elastic cloud compute really easily, whether that's production risk and P&L reports that traders are running on the desk or for R&D testing that quants are doing. So with that, thanks again. Happy to stop and take some questions. If you've got questions, please post them and I'll answer. All right, first question. Isn't this just showing Jupyter notebooks in an IDE? Is that all Beacon is? So we get this kind of question a lot. Like, are you guys just trying to sell a Python IDE or something? So no, of course not. These are just a few components of a really broad risk platform. They're integrated with the data in that platform. That's like time series data from market data, reference data, trades, positions, all that kind of stuff, as well as high-level objects like that interface to the NYMEX natural gas market that we saw. It includes all the cloud infrastructure that everything runs on. And it also includes the whole trading and risk management system. So those applications that traders, salespeople, portfolio managers, trade support staff, all that kind of stuff, that's what they all use. So today we focused on how to translate a fairly kind of theoretical bit of analytics work into production risk functionality, but there's lots more to Beacon. And if you're interested in finding out more, let us know. All right, another question, is Beacon just for commodities or does it support other asset classes? Great question. Beacon's designed as a cross-asset trading and risk system. We support most asset classes well out of the box. The commodities industry is one we've been involved with since early in the life of our companies. Commodities is really in our DNA. It's a really important part of our business, but it's just one part of the trading and risk functionality that we have. All right, another question. Are live natural gas market data available natively in Beacon? No, Beacon doesn't come with data out of the box. Typically, you have to plug your own data into it. If you've got your own in-house data warehouse or your own relationships with data vendors, we make it easy to plug those in. So we have kind of canned functionality for different kinds of vendors that lets you plug those vendors' data in, but we don't supply data ourselves. Okay, maybe one more question. How specific is this kind of factor model analysis to natural gas? Could it work for other commodities? So definitely could work for other stuff, maybe even better for other stuff. We saw how that extra complication of seasonality in natural gas forward prices means that you need something more complicated than a simple factor model like this. And you see that in other commodity markets as well, like electricity. But in other markets like crude oil don't have much seasonality, and the factor model works similarly in all those markets. Also works for other completely different markets like interest rate markets, which also have this complicated behavior where moves in forward prices don't move with 100% correlation. What it doesn't apply to is like kind of traditional financial assets like foreign exchange or equities, and it also includes commodities markets like precious metals. All right, so why don't we finish up there? Thanks again for joining. And if you have any more questions about Beacon, let us know, and we're happy to chat more. Bye, everyone.